So, finally, how does this affect you? Well, the interesting thing is that everybody wants mortgage rates to come down, but the reality is that Hello, Angelinos. Marcus Ibrahim with Team Ibrahim here, and we are going to talk about a quick real estate update for the month of October. Going to cover 3 topics. Number 1, why are mortgage rates up? Number 2, how is the market doing? And number 3, how does that affect you going forward? Let's dive in. I'm going to show you my screen here. Mortgage rates are up and away this month. Why is that the case? The answer is simple. Non-farm payrolls jumped. Today is Friday, October 8th. Non-farm payrolls jumped significantly. That means more people are employed. The estimate was for 170,000 new jobs, but the reality came in at 336 new jobs this month. So 336,000 people, more people are working this month than last month. So that means the economy is strong. And when the economy is strong, interest rates are up because the Fed wants to slow things down, not speed them up. So let's talk about how the market's actually doing, the real estate market. Then we're going to talk about why and how that affects you, how those interest rates affect you. I gotta get my little face out of here. Sorry, everyone. Okay, gonna make my face smaller so you can see the screen here. As you'll see, this month, new listings are beginning to finally decline toward the end of the year. This is a common trend that we see year after year. I'm gonna get my highlighter. You see listings up, listings down, listings up, listings down, listings up, listings down. The main difference is that this year, the height was a little bit lower than previous years, okay? You see that? So it's typical for new listings to decrease towards the end of the year. Now let's check out the active listings. Active listings remain at a low. You'll see here, remain at a low. Now let's look at days on market. Days on market are just ever so slightly beginning to climb, which means they're beginning to increase, which means properties are taking a little bit longer to sell now than they were in previous months. Months of supply. This is a similar measure, which is telling me that, given the inventory that's on the market, it's taking longer to sell, or given the time things are selling, there's more properties, but we know that there's less properties because we already saw the inventory graph, the new listings declining. So this tells us that they're taking a little bit longer to sell. Price per square foot. This has finally turned a corner for the year. You see, last year we went up and then down. This year we went up and now it's starting to peak and it looks like it's going sideways, if not down ever so slightly, which we would actually it's somewhat normal, because if you look at previous years, up in the beginning of the year, then down. Up in the beginning of the year, then, flat. Up in the beginning of the year, this was COVID, so this was unusual. And then 2021 was up and then flat and down a little bit towards the end. 2022 was drastically up, then drastically down. This year was a little bit less drastic up. And now I'm expecting a little bit down towards the end of the year, which offers some opportunities for our buyers. And let's look at this last metric, which I like to look at, which is percentage of original price. So we're hovering right around 100%, which means listings are getting what they're asking, but not much more and not much less like last year. So finally, how does this affect you? Well, the interesting thing is that everybody wants mortgage rates to come down, but the reality is that interest rates chase the economy, not vice versa. Interest rates are based on inflation. So if the economy is inflating quickly, interest rates are going up to slow it down. And if the economy is deflating quickly, interest rates are coming down to try to juice it up. So the reality is the economy is strong. more jobs are being added. That's technically good news for me and you, people who are employed. I'm self-employed, but you might be employed. So the fact that there's more people employed is kind of good news, but as a result, interest rates go up. And so people complain about the rates being high, but the reality is rates will come down when people lose their jobs. And so it's kind of a double-edged sword. So in my opinion, it's kind of, if the economy is doing okay, then you can afford to buy a house, then go for it and hold on to it. If the economy is not doing okay and you can afford to buy a house, then you get a great deal. But if the economy is not doing okay, you might not be doing as great either. So you kind of want to hope that it stays similar, maybe feather down, but you don't really want interest rates to bottom out because that means the economy is probably doing not well at all. Anyway, if you want to talk about any of these concepts further with me, please reach out. Our website is probably below. Like, subscribe, and send a comment. Anything that you have questions about, we would love to hear from you. Take care. God bless.